Last time, we followed the world's central banks as they argued over a public digital dollar, and we ended on a stranger fact. While the governments argued, private companies had already built one. Not a coin from the Federal Reserve, a dollar issued by a company. Open a crypto app, and increasingly PayPal or Venmo, and the dollars sitting there may not be the Fed's, and may not be your banks either. They are something else. A token called a stablecoin, printed by a private firm most people have never heard of. Two companies issue most of them, and to back their promise that each token is worth $1, one of those two now lends more money to the United States government than Germany does. Sit with that. $1 the central bank never made, issued by a company, backed by so much American government debt that it outranks a nation. That is not a warning. It is simply how a growing share of digital dollars now work. So today, we do the calm thing. We explain what these dollars really are, who prints them, how the promise holds, how it has broken, and the quiet twist of power underneath it all. Because the true answer to who issues the money in your app is stranger than either side of the argument will tell you.
Start where we left off, with a hierarchy of money. Because the word dollar hides a ladder of very different promises. At the top sits central bank money, the safest, most final money there is, issued by the state. Below it sits the money in your bank account. That is not central bank money. It is a promise from your bank, an IOU, backed by deposit insurance and by regulation, a claim on a private company. A stablecoin adds a new rung, lower still. When your app shows a stablecoin balance, you do not own $1. You own a claim on a company, a private firm's promise that somewhere, in a pile of reserves you cannot see, sits something worth $1 for every token. And here is the part that surprises people. A bank deposit is a claim on a bank, and it comes with deposit insurance. A stablecoin is a claim on a company, and for most people, it comes with neither insurance nor a personal right to walk up and cash it in. You are, in plain terms, an unsecured creditor of a private firm whose product is $1. Now, that promise works astonishingly well, most of the time, which is exactly why hundreds of billions of dollars now ride on it. But it is still a promise from a company, not money from a central bank. And the whole story, the usefulness, the power, and the risk, begins with that one difference.
So, who prints these dollars? Overwhelmingly, two companies, and since these figures move, treat them as dated. As of this reading, roughly 9 out of every 10 stablecoin dollars come from just two firms. The first is Tether, which issues the token called USDT. It is the biggest by far. It operates offshore, outside the United States, and it is remarkably profitable. In a single recent quarter, it reported over $1 billion in profit, earned mostly on the interest from its reserves, while paying its token holders nothing. Its reserves are mostly US government debt, but not only that. The mix also includes gold, some Bitcoin, and other assets. And historically, Tether published quarterly attestations rather than a full financial audit, though it says a full audit has now begun. The second firm is Circle, which issues USDC, the regulated American answer. Its reserves sit overwhelmingly in short-dated US Treasuries and cash at regulated banks, checked by monthly reports from a major accounting firm. And in the middle of 2025, Circle listed on the New York Stock Exchange, where its shares jumped well over 100% on the very first day, a loud signal of the appetite for this business. Two firms, two models, one offshore and lightly disclosed, one American and tightly regulated. Between them, they issue most of the digital dollars on Earth. Which raises the real question: what actually stands behind the promise?
Here is the machine, simply. When a large, approved client, a trading firm, an exchange, hands the issuer one real dollar, the issuer creates one new token and hands it over. That is minting. When tokens come back, the issuer pays out $1 and destroys the token, burning it. $1 in, one token out. That loop is supposed to keep the number of tokens matched to the pile of reserves.
But here is the part almost no one explains. That direct swap, hand in tokens, get real dollars from the issuer, is generally only for large, vetted clients. Most ordinary people never redeem with the company at all. They buy and sell the token on an exchange at whatever price the market sets. So what holds the price at $1 for you? Not your own right to cash out. It is arbitrage. If the token slips to 99 cents, big players buy it cheap and redeem it with the issuer for a full $1. And that buying pushes the price back up. The peg holds on three things at once: the issuer's promise, that arbitrage, and confidence that the reserves are real. Now, hold two images together. The token itself lives on a public blockchain. It moves anywhere on Earth in seconds for pennies around the clock. But the reserves behind it sit in the old, ordinary financial system: bank accounts, money market funds, treasury custody. A futuristic token bolted onto a very traditional pile of assets. And the token can only ever be as safe as that pile.
So why is serious money piling into this? Because the usefulness is real, and we should say so plainly. Start with speed and cost. A stablecoin can move value across the world in seconds, at any hour, often for a few cents, against traditional transfers that take days and charge 5 to 10%. For the people paying those fees, that is not a small difference. Then there is dollar access. For someone living under high inflation or strict currency controls, a dollar stablecoin is a way to hold and send dollars from a phone without a US bank account. In parts of Latin America, Africa, and the Middle East, these flows have grown to the equivalent of several percent of the whole economy. And this is no longer a crypto-only story. Stablecoins are moving into apps people already use. PayPal and Venmo have their own. Stripe, Visa, and MasterCard have all bought into or built the plumbing. By some counts, well over 100 million Americans can now reach a stablecoin through an app they already hold. One honest caveat: most stablecoin volume today is still trading inside crypto markets, not everyday shopping. But the direction is clear, and the tools underneath are genuinely fast, cheap, and global. That is the case for stablecoins, stated fairly. Now the other side, stated just as fairly. Because the same design that makes a stablecoin fast and global also makes it fragile, and that is not a theory. Remember what you hold: a claim on a company with no deposit insurance and usually no personal right to redeem. That leaves a stablecoin exposed to the oldest problem in finance: a run. If enough people fear the reserves are not there or not reachable, everyone tries to exit at once. The token trades below $1. And if redemptions are paused, the arbitrage that normally restores the price stops working. This has happened. Over one weekend in March 2023, the regulated one, Circle's USDC, broke its peg. About $3.3 billion of its reserves, roughly 8%, sat inside Silicon Valley Bank, which had just collapsed. The tokens on the blockchain were fine. The problem was off-chain, in a failing bank. USDC fell to as low as about 87 cents, and only fully recovered after the US government stepped in to backstop the bank's deposits. Note that carefully. The reserves were real, just briefly trapped, and it took a government backstop to restore calm. The Federal Reserve's own later analysis drew the measured conclusion: stablecoins can hold their pegs in normal times, but may still be fragile under serious stress. And history matters. Back in 2021, Tether paid tens of millions to settle findings that it had misrepresented its backing. One regulator found the token had been fully backed on only about 28% of the days in an earlier sample. Tether says its reserves are very different today. Both can be true: a documented past and a changed present.
Now, the twist the whole story turns on. To keep their promise that every token is worth $1, these companies must park their reserves in something safe. And the safest, most liquid thing on Earth is US government debt, Treasuries. So the two big issuers have become enormous buyers of US Treasuries. Follow that to its end. By Tether's own reserve reports, It now holds well over $100 billion in US government debt. By common comparisons to the Treasury's own data, and treat this as an illustration, not a precise league table, that places one private company among the largest holders of American government debt in the world, reportedly ahead of entire countries like Germany and South Korea. Read that twice. A company most people cannot name lends more to the United States than whole nations do. And here is why it matters for power. Last time, we watched the United States look at a public digital dollar and say no. This is the other half of that decision. Rather than issue a digital dollar itself, the government let private companies do it. And those companies, to back their dollars, promptly became some of its fastest growing creditors. The digital dollar was not nationalized. It was privatized. And the private issuers became financiers of the state. That is a genuinely new loop in the machinery of money, and no one fully knows yet where it leads.
So the United States wrote that choice into law. In 2025, it passed a statute known as the Genius Act, the first federal rulebook for these dollars. Reported plainly as policy, it requires a permitted issuer to hold full reserves, one for one, in cash and short-term US government debt, to publish what is in those reserves every month, to submit to an audit above a certain size, and notably, to pay the holder no interest. It is the American answer to digital money, not a public central bank dollar, but private dollars, inside guardrails. And whether that answer strengthens the country or strains it is where serious institutions genuinely disagree. On one side, call it the dollar power case, the argument is that this hardwires the world to the dollar. Billions of phones holding digital dollars, a fast-growing, rule-bound buyer of US debt. Voices at the Federal Reserve and the International Monetary Fund describe it as America's old advantage, digitized. On the other side, the system risk case, the Bank for International Settlements, the central bank for central banks, argues that privately issued money, which can trade at different prices and can run, fails the basic tests of sound money. In Europe, officials worry about a quiet dollarization of their own economies through these tokens. Both cases are argued right now by institutions that do this for a living. The honest position is to hold both, and to predict neither.
So, pull it together. Who really issues the digital dollars inside your apps? Not the Federal Reserve. Two private companies do, Tether and Circle. And their dollars are promises, backed by reserves you cannot see and mostly cannot personally cash out. To keep those promises, they bought so much US government debt that one of them now lends Washington more than Germany does. That is the shape of it. A digital dollar the government chose not to issue, handed to private firms who then became creditors of the state. It is genuinely useful money, fast, global, a dollar in a pocket for people the banking system skips. And it is genuinely fragile money, a claim on a company with no deposit insurance that has wobbled before and could again. Whether it makes the dollar stronger or the system more brittle is a real, unsettled argument, not something anyone can honestly predict for you. What you can know is the plumbing. So the next time an app tells you that you hold dollars, you can ask the one question that actually matters. Whose promise is this? That is not a warning, and it is not a pitch. It is simply knowing what you are holding. One note, as always. This has been educational analysis of how the monetary system and public policy work, not investment, financial, or trading advice, and not a prediction. Nothing here is a recommendation to buy, sell, hold, or avoid any stablecoin, token, currency, or asset. The figures are dated and drawn from primary sources. Verify the current numbers before relying on them. And that leaves one last thread. Because stablecoins only put the dollar on these new rails first. Right now, the biggest names in finance, the giant asset managers, the banks, the world's stock exchanges, are moving their own assets onto the very same rails. Treasuries, funds, even shares of stock. It is called tokenization. So what happens when Wall Street's own assets move onto these rails?
And who controls the pipes that everything then runs on? That is where we follow the money next. This has been Money and Power Explained. Follow the money. It always leads to power.